Well, hello everyone. This is Edmund Bradford, and I'm delighted to have with me today Professor Malcolm McDonald. And we're talking about three things, really. We're talking about shareholder value, marketing, and how that connects to being a good company. And in the last video, we just kind of got an introduction to the subject of shareholder and what shareholders are interested in. But I know I've heard Malcolm talk about this a lot, and it isn't easy to package it up into a few small minutes. But I think it'd be interesting just to at least pick up on the subject of shareholder value added, which can be very technical, but I think it's worth just trying to get our head around that particular area. So hello, Malcolm, and welcome to our little interview again.
Hello, Ed.
Could you summarize, what is shareholder value added and why anybody should care about it?
Well, I must say it's an enticing thought to try and make a topic like shareholder value added interesting and exciting, because it clearly isn't, other than to those people who benefit from it. In the main, these are shareholders. But let's keep it simple. I mean, what is it? Well, everybody knows what net free cash flow is, and it's net free cash flow having taken account of the time value of money. And you think that's not a difficult concept, because the time value of money, you'd rather have a pound or a dollar or a euro today than you would in 5 years' time. So having taken account of the time value of money, the cost of capital, which I'll talk a little bit about because it's not the most exciting topic in the world, and of course the risks associated with the company or the organization's strategy. And let me give you one very simple example of this. If, for example, keeping the math simple, the cost of capital is 10%, and you're a small company and you've got £20,000 invested in your company, and as I say, the cost of capital is 10%. If you make a net profit, net free cash flow of £1,500, you have actually destroyed £500 worth of shareholder value. If you, on the other hand, make £2,000 net free cash flow, net profit, you have neither created nor destroyed shareholder value. If, on the other hand, you create, let us say, £2,500 worth of profit, you've created £500 worth of shareholder value. And the question I ask most people, I say, what sort of numpty, what sort of idiot would deliberately set out to destroy shareholder value? Because the point is, it started off with a guy called Rappaport, and then morphed into what's become shareholder value added. Now, the world is full of expressions like return on investment, RONA, DCF, payback, net profit, EBITDA, brand equity, customer lifetime value, and so on. Each one in its own way is very valuable and tells you something different. But the reality is that the one that has filtered to the top over the last 15 or 20 years is shareholder value added. And if you, rather than going into all the details, it's quite important for marketers, for example, to understand what the cost of capital is, because every organization has it. It's the one hurdle you've got to get over in order to justify investment funds. So, that's one side of it. I talked about the time value of money. The big one, however, and the complicated one, is this expression I use, risk, the risk of the strategy of the organization. It's extremely complex, and I don't want to muddy the waters now, other than to say, there's a model called the capital asset pricing model, which explains how stock markets work. And all I'd say is that, in summary, a normal, rational, risk-averse investor requires an increase in expected future returns for any more risky investment in order to compensate for any potential volatility. I mean, that to me is a blinding glimpse of the obvious. But risk assessment has risen very high on the agenda of those organizations and people like me who work with organizations globally in assessing risk. And the best companies in the world do assess risk formally. We call it due diligence, but the best companies have processes in place to make sure that they have taken account of risk in their predictions for shareholder value added. And I think probably, Ed, I will stop there because, as I say, it's not the most exciting topic in the world, but I hope I have at least explained how it works and why it is so important.
You have, Malcolm, and you've done that admirably. Normally, I know when I hear you present this, you've got some charts and graphs and things to help. And I think in concept it's actually quite simple, really, because what we're saying is that an investor has different alternatives to where to put their money. And if you're not delivering the minimum returns, the cost of capital that they're looking for, they don't need to invest in your marketing project or even your company at all. They can invest that money elsewhere and get a better return. So just because you've got a good payback plan, you've got you're making some good profits, doesn't necessarily mean that actually you've reached their minimum cost of capital. And that cost of capital, as you said, is dependent on time adjusted returns, and it's also dependent on the risk that's factored into it. And that is a big area. And I know, Malcolm, in your books, for example, in marketing and finance book, you talk about different types of risk. For example, market share risk is one sort of risk. In our book that we did together, there's an implementation risk as well, that the objectives that you set out, the strategy that you laid out doesn't get implemented successfully. So risk itself is a huge area, but I think in a way marketers can't shy away from it. Understanding risk and how it's used is a major area to get your head around.
Yeah, and I suppose it's pretty obvious at the end of the day, Ed, that if a company has a history of its profits going up and down, and and so on and so forth, it's known as a volatile company, and therefore the shareholders will require a higher return to take account of that risk. So it's a pretty simple concept at the end of the day.
Excellent. Thank you, Malcolm. Thank you for simplifying what can be a very difficult and technical subject. I'm sure that's really useful to a lot of people. In our next video, we're going to be talking about how a good market strategy could improve shareholder value. So thank you again, Malcolm, for your time this morning. Much appreciated. I look forward to our next conversation.